So I'm going to show here how I use long-term technical analysis on the monthly chart to protect against downside risks in the equity markets. So I'm looking at the S&P 500 here on the monthly chart, and I'm looking at the S&P 500 because it's the biggest stock market in the world, and it drives most of the globally diversified funds that we're all invested in these days, in pensions, ISAs, 401ks, and all the rest of it. So what I try and do here in this channel is just to look each month at both the S&P 500 and globally diversified funds and use basic technical analysis and a mix of 3 or 4 indicators to tell me if I want to deallocate or reduce allocation to equities. As simple as that. So when we're long-term investors, so when we're going up, and we remain invested. All we're really interested in is catching the downside before it becomes a real problem. So we're looking here at the dot-com crash here in 2000 and the Great Financial Crisis 2008 2009. So I'm just going to go through the decision-making process that I would use using these technical indicators. So what I've got here is the RSI, so this, again, monthly long-term RSI, and the MACD. So real basics really, and that's really all you need. In combination with that, I use the moving averages, the exponential moving averages. You can use simple moving averages, but I just use the EMAs here for the 10 period and the 20 period. So this would be 10 month and 20 month. And that's the green line is the 10 month, and the red line here is the 20 month. So if we take a look at when we're going up in the rising market here, so this is going back to like 1993 here, you can see there's only, as you on the way up, we're generally trading above that 20 and 10 moving average, and you can see that for the most part we might get at most two months going down, and it's only when we get into this situation where we see multiple months, 3 months, 4 months here, where the real sort of warning signs. We've had 4 months, say for example here 2008. When you see 3 months, the first kind of warning sign really I'll be looking for is when you see 3 months of decline. So let's take the top of the dot-com bubble here in 2000. We see in September 2000 we start to come down below that 10 monthly moving average. We have a third month here which takes us to the 20 month moving average. So third month, that's warning sign 1. The 10 month is pointing down, that's warning sign 2. We've hit the 20 month moving average, that's warning sign 3. And on the RSI, this is all being confirmed on the RSI. You see here with the 70 line here is beginning of the shaded area here. So we're coming down below from an overbought position. We're coming down below that that RSI threshold there. Just here you can see, and the MACD on that same month. So let's take it to what we've got here is November. So if we take the reading here, so we've already come down quite a long way on the RSI. So I might have chosen to come out before that, or at some point maybe when we hit the 20 month, go down below that 20 month moving average. But the general decision to come out of the markets or deallocate to equities is being confirmed by all 4 indicators here. 10 month coming down, but the price action come down below the 20 month, 10 months now pointing down, RSI coming down off the overbought position, and the MACD is confirming this as well. We can see here that it's starting to, it was drifting sideways, but it's now pointing down. The sell signal with the signal line crossing below the MACD line here, they're putting some distance between the 2 lines here, the MACD line and the signal line. So this is all pointing to a deallocation from equities, and of course it would also be combined here with sort of the fundamentally bad news of the dot-com bubble going popping, profits not being realised, unemployment rising, etc. So all of the warning signs that there's a real problem in the markets here would point me towards coming out of the markets probably altogether at this point. That decision would be proved correct when the 10-month comes below the 20-month. That is also a sort of big warning sign that there's going to be further downward momentum in the markets, and we see that being proved correct and playing out here over a period of about a year or year and a half. So then we come down to 2002 here, October, and the first kind of sign of recovery is when we've hit the RSI here. So we're very oversold, down to about 20, and we see it come back up here. And we see it come back up, and we're moving towards the 10-month moving average there, the green line. We see it come back down, so we're still on that sell signal on the 10 to 20 EMAs here. And as long as we're sort of trading below that 10 monthly moving average, I'd sort of remain out here. It's only when the MACD points up here into a sell signal, we get the RSI diverging up here. There's upward momentum, sort of a higher low here in the RSI. That's matched with the higher low here, which is the first higher low that we've had since the downturn. And we see a higher low being formed here. We come back up from that higher low to the 10 monthly moving average there, with the RSI coming up and the buy signal now on the MACD. That would tell me that it's a fairly decent probability that the tide has changed there, and we're going to go back up here. That's exactly what we see playing out, and then that decision is confirmed by the 10 monthly crossing over the 20 monthly here, and then we see that we ride this, and then that monthly gap here you can see is telling you to remain in the market, and it's the price action on the monthly is happily bouncing off of that 10 monthly moving average of support. So again, we are invested until we get to the great financial crisis, and it's a similar. You see the similar process here. Also there's a sort of double top here. You see a double top here, so that's a warning sign. We're coming down, breaking down in the third month, back down to that 20-month moving average. So we see the exact same pattern playing out here at the start of the great financial crisis. RSI coming down, sell signal on the MACD. That's telling me to deallocate, that the tide is turning again, and we see that play out once again. So it's the same process, and that's what I'm doing each month. You'll see each month on the S&P 500 and on globally diversified funds that I'm looking at carry out the same analysis. So if you want to follow along, subscribe, and there'll be playlists for both the S&P 500 and global funds, and you'll see what I'm thinking about how I'm allocating to the equity markets.